Hello guys, welcome back to my channel. I hope you had a great weekend. I feel better. I believe you'll be able to tell. I feel a lot better and I want to go in depth, give more detail as I promised in my previous video. I realized that I've not been very detailed in my analysis and my forecast and the levels I present to you. So I intend to do a lot more going forward. So this is going to be a lot more detailed than my previous outlooks and reviews. This is a list of the things we're going to do. We're going to go through the seasonality of the bond yields because that is what is most prevalent in this current climb. I realized that the DXY, the Euro USD, the Gbpusd has not been very clean and has not really respected the seasonality this year. However, the bond yields have been spot on with the seasonality. We'll discuss that and then we'll look at the bond yields, of course. We'll look at the interest rates following that, and then we'll look at the DXY, the Euro, and the Pound for this week. So let's get right into it. Let's start off actually with the interest rates. This is the US interest rates. Last week, we had interest rate announcements from the Federal Reserve and the FOMC. It was left unchanged at 5.5%, which was of course a hawkish stance by the Federal Reserve and the FOMC because of the inflation rates being higher than anticipated and expected. Right now, the dollar has a bullish sentiment, right? The pound has an interest rate announcement this week. We've had some other interest rate cuts recently. Last week, we had interest rate cuts from the Bank of Canada and the European Central Bank. So that being said, this is where we stand with our interest rate right now. The dollar seems to be the best currency to be buying right now based on the hawkish stance of the Federal Reserve and the highest interest rates from the major currencies. If you are looking to buy the dollar now, it looks like a very good time to be a bull on the dollar. Up next, let's look at our bond yields. This is the 5-year bond yield for the US dollar. Now, this is the 1-year time frame. So we've been bearish for the longest time. We had a turnaround around here, and then we've been bullish since 2021 all the way to the current month and year that we are in. Right now, we're pressing up against this other block. We've been pressing up against this other block for about 2 years now. We broke market structure around here. Go down to the 6 months time frame. You see it more clearly. We broke structure here, and then we continued pressing higher. Let's go to a lower time frame. All right, so let's look at the monthly time frame. Okay, so as per our previous outlooks, if you've seen our previous outlooks, you understand what is going on here. We've been pressing higher, pushing higher. We broke this level, came right back to this other block and pushed higher again, breaking this level here and then pressing back down into this other block. And since then, we've been making higher prices until this last 2 months that closed bearish on the 5-year bond yield. Now, if we go lower to the weekly time frame to get more detail, you see right here, this was the last other block we pushed from. Starting out the year, we had a divergence. You should know about this if you've seen the previous outlook, but I'll still go through it because I want to be more detailed. So think of this as the first start to our analysis together. So we had a divergence here between the 5-year bond yield and the 10-year bond yield. Let me quickly pull that up. The 10-year bond yield. Alright, so right here we see the 5-year bond yield making a lower low. However, the 10-year bond yield made a higher high. This started out the bullish run for the year, and we've had higher prices ever since January all the way to April, and even right now we are still bullish because we're still maintaining that bullish structure. No major level has been broken to turn the trend around, so we are still bullish. As per the interest rates that we just looked at, the dollar has the bullish sentiment. It's very strong. The Federal Reserve is very hawkish. That being said, we're still very bullish. The bond yields still look very bullish even on the weekly time frame. Now looking here at the daily time frame, we had a rejection of this other block right here that pushed us right onto this other block, and then we had price melt down all the way from the ending of May down to middle of June, which we are in right now. So let me take this off. We don't need this anymore. We don't need this anymore as well. Okay, so we're currently riding off this other block. We've been pressing lower continuously. We broke structure here. We tapped into that other block that I just took off. We pulled back into this other block. Then we broke structure here. We pressed down, taking out this level. Retraced right into this other block here. So I can make that another block. Okay. And then we press down during CPI release and FOMC, PPI, consumer sentiment, throughout last week, we were massively bearish on the 5-year bond yield. That being said, we are having a discrepancy between the bond yields and the DXY. As you know, the DXY is positively correlated to the bond yields. As I explained in my previous video, but I'll briefly explain again. What do bond yields mean? Bond yields are basically interest rates on bonds. Now, those bonds you buy from the government has yield, which is basically interest rates. And as we know from the previous videos as well, interest rates interests investors. You get me? So when interest rates are high, investors are interested. If I give you two opportunities, one with a 3% interest rate and one with an 8% interest rate, you'll be interested in the one with 8% interest rate. It translates to the financial market. If the bond yields are going up, investors would look to buy the bonds so that they can make higher yield on the bonds compared to other bonds. So if the US bond yield is going up, it would make the dollar go up as well, because to buy the bonds you need dollar, and when you get the dollar, demand for the dollar increases as investors want to buy the dollar to buy the bonds, which will make the dollar increase in value. So technically, when the bond yields go up, the dollar should go up. And as we know, whenever there's a crack in correlation between two correlated assets like the bond yields and the dollar, pay attention, something interesting is about to happen. Now let me pull up the DXY right here. We have the DXY. So if you look over here, you see that for the longest time, the DXY and the 5-year bond yield have been correlated here, up, down, up, down, up, down, up, down. But then if you look over here, you see that we made a low here. We also registered a low on the DXY. However, we made a lower low here on the 5-year bond yield, but we made a higher low on the DXY. Now, that is a cracking correlation. That is a divergence. The important thing to take note of here is the divergence is happening on the lows. The divergence happening on the lows means there's accumulation. This is a sign that we might be turning around very soon. And this ties into our bias to have higher bond yields going forward. Now, this divergence between the DXY and the 5-year bond yield is one of the confluences we have to be bullish on the bond yield. Very soon, we'll look at the DXY and analyze the DXY and see what bullish signals we have there to correlate with this potential bullishness that is coming up for the 5-year bond yield. Now, I would like for us to look at the seasonality, right? Now, if you don't know how I got this indicator, I explained in my previous video how I use the indicator, how I add it to my charts, the settings I use and all that. I'm going to put a link to that video in my description box so you can check it out after watching this video. But for now, just focus on what I'm explaining to you about the seasonality right now. So, like I said, the US 5-year bond yield have been spot on this year. It has been almost perfect. So this is one of the other things I would like to look at and add as a confluence to my bullish stance for the 5-year bond yield going forward. Right now, if you look at January, we see that January was basically a flat month, but then was slightly bearish based on the seasonality. Seasonality called for a bearish January, and this data has been collected over 36 years, so it is quite significant. So looking at this, February, we started out very bullish, which of course February supposed to be a bullish month based on the seasonality, bullish, and then we retraced into March, which was of course also bullish, and then during April we just continued bullish. Starting out May, as the seasonality predicted, exactly as expected, we started selling off throughout May, and going into June we sold off, and now we're in the middle of June. Like I said, if you don't really understand how I use the seasonality, you should check out the video where I took my time to explain how I use seasonality and some key points that are very important when using seasonality. One of which is seasonality is not a signal. It's not a buy or sell signal. It is a confluence. It is not a definite thing. It doesn't mean that a month flashing a bearish seasonality means that month must be bearish. It is just a confluence, right? So looking at this, if you did not know that, you would have been buying throughout June, but June has been bearish for the first 2 weeks. But that doesn't mean this negates the bullish tendency of June. The bullish tendency can still kick in as I expect, seeing as we have some bullish sentiment from the interest rates. The structure looks quite bullish, and then we're having a discrepancy, a divergence between the DXY and the 5-year bond yield, and we also have a bullish seasonality for June. That being said, I expect this seasonality to kick in the coming weeks before we come to the close of June to see higher prices on the bond yield and of course on the DXY. Now that being said, let's look at the DXY. So this is the DXY on the 1-year time frame. We had this other block, we tapped into this, we broke structure here. We broke this level, we came back, respected it, and right now we're pressing up against this other block. We've been here for the past 2 years, right? So let's go right to the 3 months time frame and see what we can see. Okay, so this is the other block that we pressed into towards the end of 2022, pulled back, and we tapped into this other block, and that is where we've been consolidating for a while now. We go to the monthly time frame. Okay, let's go to the weekly time frame to get a better view of that. Okay, so this is the consolidation that I just spoke about, and this is the other block that we tapped towards the end of 2022. Okay, so we pulled back, we broke structure here, and then we've basically made 3 drives. This 3 drive pattern is a very important exhaustion pattern that I use. It shows that the impulse is weakening and there's a potential turnaround coming very soon, right? So we tapped into this other block after this 3 drive pattern. We broke structure here. We came right back to tap into this other block. Now, the trend has been bullish since the tap into this other block happened. We've been pressing higher and higher and higher, and this is where we are right now. Towards the end of April, we tapped into this other block and had a pullback, and now we seem to have turned around and continuing that bullish trend to potentially this other block. This is the target. This is where I expect price to go. Take out this high, tap into this other block, and then at that point we'll see what happens going forward. So right now, this is where we are. If we go to the daily time frame, this is the other block that pushed us down from April all the way down to June. So we've come all the way down, we've tapped into this other block. We had a divergence between the euro and the DXY. You know, the DXY is negatively correlated to the euro, so when there's a crack in that correlation, like I said, we expect interesting price action to happen, which is exactly what has happened here. We quickly look at the euro to see that divergence. This was the higher low on DXY and another higher low, but then we made a higher high than this high on the euro. So we printed this divergence, high here, high here. That should not happen. We should have a higher high and a lower high, but we had a higher high and a higher high. So that was the divergence. Now, since we printed this divergence going into the end of June, we've been having higher prices on the DXY and lower prices on the euro. That being said, this is where we find ourselves now. We don't need this other blocks anymore. This is what we have. We had this sweep of this low here, and then we had that divergence between the DXY and the Euro USD. We broke this level here and retraced right into this other block during the CPI release. We had this rejection during FOMC, and towards the end of the week, Thursday, Friday, we pushed up, taking out this high and this high. Now, this is where we find ourselves currently. We are bullish from the interest rates. We're bullish because of the bond yields. We're also bullish because of the seasonality of the bond yields. We are bullish on the DXY as well. We have this divergence between the DXY and the euro. A lot of confluences saying we should be going higher, right? However, after this push, I expect a retracement. So going into next week, even though I'm bullish overall, I would be looking to sell the dollar up until we get to this other block, and then I would look for higher prices. Now, how we trade into this other block next week will determine if the whole move for next week will just be a retracement into this other block or a retracement into this other block to go higher to take out these highs that we have over here. These highs, right? So my bias for the dollar is bearish going into next week up until this other block right here. So that being said, let's quickly look at the euro. On the yearly time frame, you realize that the euro is very similar to the dollar because it's inversely correlated. It is very tightly knit with the DXY. This is because the euro makes up about, I can't remember the actual percentage now, but upwards of 50%, about close to 60% of the DXY is made up of the euro. So they are inversely correlated. If the DXY is going up, the euro is going down with almost identical price action, just inverted, right? So this is what we have right now. For the longest time, the yearly time frame, we've been pressing higher, taking out highs, pulling back to other blocks, taking out highs, pulling back to other blocks on the Euro USD. So now the most recent price action here, we took out this low, we returned to this other block, and then we returned direct to another other block around here and pushed down. If you notice here, we have a divergence between the Euro USD and Gbpusd, because Gbpusd and Euro USD are correlated assets. So whenever there's a crack in that correlation, something interesting is about to happen, like I always say. let's quickly look at that divergence between the euro and the pound USD. Okay, change this to Gbpusd and look at it. Okay, so if you look at it from the yearly time frame, it's very interesting because from as long as we have data on TradingView on the FXCM data feed, we've been trending lower all through. It has just been a massive downtrend on the pound and a massive bullish trend on the Euro USD. So that on its own is a discrepancy, but then it is very, very, very long term. This is as far back as 1971. So this is the divergence I'm trying to point out to you. The divergence between these lows on the euro and the lows on the pound. You see we had a higher low here, but we printed a lower low for the pound USD. Okay, so let's go straight to the 3 months time frame. The most recent price action, we're looking at the reaction of this order block. Let's go to the monthly time frame. Okay, so we had the reaction of this order block here, and that was the last 2 quarters of 2022. We had this push. Let me mark out this market structure break right here. We broke market structure here, and then we've been pushing higher ever since, right? Let's go to the weekly time frame to see this a little clearer. Okay, so we broke market structure here, and then we had this, remember, this 3 drive pattern, 1, 2, 3, and then we broke structure, tapped into this other block, and then we've been falling ever since this year started, since January 2024. Now I expect the Euro USD to drop into this other block and potentially into this gap, but of course this is my conservative target. If we tap this other block and we don't show any signs of reversal, then I would expect price to come into the high, potentially the low of this gap. But for now, we stick to the other block, right? So we broke structure here, we tapped into this other block. Let's go to the daily time frame to see more recent price action. Okay, so right here you see what has been happening more recently. Of course, we have another divergence here between the Euro USD and the Gbpusd. See this high, point it out, this high to this high, we made a higher high here. But if you look here, we made a lower high on the Euro USD and a higher high on the Gbpusd. That is a divergence. Okay, we took out this low, we pulled back into this other block. We pushed down, took out this low, and we've come right back into that other block for the second time, and then we printed a divergence between the Gbpusd and Euro USD. Again, let me point that out. This is the pound USD. You see from here, better still from here, so we have the exact same point. We made a higher high on the pound USD, but we made a lower high on the Euro USD. Another divergence. So we've been having a lot of confluences pointing to lower prices on the Euro USD, tying in very well with higher prices on the DXY and lower prices on the pound USD as well. We'll look at that very soon. So we've had this divergence here to show that we are going lower, right? So we broke structure here to start out last week. We pulled back during CPI, had a rejection during FOMC, and then we pulled down Thursday, Friday. Now going into next week, just as my bias is for the DXY, I expect a push up into this other block. I did not mark it out. Let me mark it. So right here, this other block. If you notice, I do not go lower than the daily time frame. That is on purpose. This channel is not meant to give you signals or entries. I am just giving you my bias for the week. So if you know what my bias is for the week, you look for your own entry signals by yourself and take those trades of your own volition. So I stick to the daily time frame as my lowest time frame for this analysis. But what you should know is I expect us to push higher from here. I expect price to go higher for the week into this other block, and then we look to sell from there. Now whether the sell would happen this week or next week is not really important. The point is I'm bullish into this week until we get to this other block, and then I would look to switch my bias to sell. That being said, let's look at the pound USD. Let's quickly do this because this video is getting very lengthy already. Okay, we had this other block, we tapped into it, we broke, we tapped into this other block, we broke again, tapped into this other block, and then we've gone down to take out this low and register that divergence we talked about with the Euro USD. Let's look at the 3 months. Okay, so yeah, nothing much. Let's look at the monthly time frame. Okay, so we have some more details here. If you look at this, what do you spot? Take a few seconds, look at it very well. You see we have the 3 drive exhaustion pattern, like I've been explaining throughout this video. 1, 2, and then the third one, when we have this happening, when we're approaching a point of interest, another block, a key level in the market, it is a very good sign that the impulse is dying out and a reversal is about to ensue. Okay, let's look at the weekly time frame to look at more recent price action. So we broke this level, right? We came right back into it towards the end of 2023. We tapped it, we pushed away, we tapped into another block around here. I don't have it drawn, but there should be another block here which we tapped into, and then we pushed right back down into this other block right here. And then since then, we've been making higher prices until we hit this other block towards the end of May and June, right? Going to the daily time frame to get more details. You see right here that divergence between the EURUSD and the Gbpusd, and this divergence between the EURUSD and the Gbpusd as we discussed. So we tapped into this other block. We've broken market structure here. Yet again, I want you to look at this. Do you see what I'm trying to point out here? 1, 2, 3. What's that? The 3-drive pattern. The 3-drive pattern, when we're tapping into another block, very, very high probability, right? So we have the 3-drive pattern, we tap into another block, we have a divergence with the EURUSD, and we broke structure. That is perfect recipe for a very good impulse to the downside, right? So we've broken structure here, and my bias, the same as my bias for the EURUSD and inverse to my bias for the DXY. Now that we've broken structure, I expect us to push up into this other block right here, and then we have lower prices going forward up until this other block. This is what I'm looking at, right? So going into next week, I expect a retracement into this candle, and then we'll have some kind of signal to sell along with the EURUSD and then buy DXY. Okay, so that being said, let's quickly look at the economic data that we have for this week. We have a lot of economic data for this week as well. Monday, Tuesday, Wednesday, Thursday, Friday. Every single day we have high impact events for the dollar, the euro, and the pound. So we have the Empire State Manufacturing Index on Monday. On Tuesday, we have the core retail sales and retail sales for the dollar. On Wednesday, we have CPI for the pound. We have a bank holiday for the dollar on Wednesday, so take note. On Thursday, we have the monetary policy summary, the Monetary Policy Committee official bank rates votes, and the official bank rate. So this is when we would have the announcement for the pound interest rates going forward. It will be, I wouldn't say quite volatile, but quite frankly, I expect the Bank of England and the MPC, the Monetary Policy Committee, to drop interest rates. Seeing as the Eurozone has dropped their interest rates, I do not expect the pound to hold interest rates going into next week. But we'll look to see. As I said, I don't like anticipating. I'm just giving my thoughts, what I think. We also have the unemployment claim on Thursday. And on Friday, we have retail sales for pound, we have manufacturing index for Eurozone, we have manufacturing index basically for Germany, from France, and flash manufacturing PMI and flash services PMI for the dollar on Friday. So that's basically it. My bias for the pound is bullish until we get into this candle and then look for some bearish signals. My bias for the euro is bullish until this other block, look for some bearish signals, then to go bearish. My bias for the DXY, bearish until we get into this other block, and then we look for some signals to go bullish to continue that trend. And I look to see how we turn around and have some exhaustion signals or divergences going into next week on the bond yield. That being said, have a great week. Trade safe. I wish you a profitable and a lovely week. Take care. See you in the next video. Bye. If you watched to this point of the video, leave a thumbs up. Subscribe if you haven't, because why not? Share this video with anyone who you believe would find value in this video. And until next time, stay safe, trade safe. See you in the next video. Take care.